Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm going solo to talk about an important topic that I have covered in the past, but it's time to talk about it again, and that is, should you buy more of your loser stocks? We all own them. Maybe we don't really want to, but we do, and we keep thinking, oh, if only I dollar cost average here, or, oh, this stock looks cheap. I've owned it. I bought it at 25. It's at $8 now. If I buy a few more shares, I don't feel so bad because I'm getting it cheap. But are you really getting it cheap? And what does it say when a stock is plunging that much when the rest of the stock market is not? So all these things are out there. These kinds of questions are brought up for every investor. Even professionals have to grapple with this issue of how long do you hold on to a stock, not one that's soaring and you're wondering if you should sell it, but one that is really in the doghouse and you've owned it for years, perhaps. And maybe it was a big winner for you even a decade ago, as some stocks can be, but then it spirals down. You do have loyalty to it. So then you hang on and then you buy more shares. Should you buy more shares of these loser stocks, or should you just take the pain, cut your losses, move on to something else? That is difficult to do. All of us have been there. All of us have owned at least one stock that's like this. Even the great Warren Buffett has owned some stocks where he's bought further and the stock just didn't go where he thought it might go, or as he would say, the company and the business didn't, and he ended up selling. He took a loss on IBM, for instance, and he owned that for numerous years. Many people were like, why is he still in it? Well, because all investors have this difficulty, especially if a stock appears cheap or is at like a 5-year low. And then you begin to ask yourself, as someone asked me just a few days ago, well, it can't go under, can it? But yes, many companies that you think can't go under definitely can. Many of us have been caught up in this as well, especially during the financial crisis. Obviously, many banks went under. Big name banks that had been around 100 years went under. But it can afflict every type of company. Think of names like Kmart or Zayre or Montgomery Ward's or Webolt's or Sears. If you had asked 50 years ago, Sears can't go under, can it? Well, yes, these companies can. So you have to really ask yourself, when you own a company like this, remember, it's the same as anything in your investments. What are your goals for this money? What are you hoping to achieve? And are you achieving it? And also, you have to look at the underlying business of the company. There's a reason usually that a stock is at a 5-year low when the rest of the market is not also doing so. Then you have to ask, what is happening with earnings? Are they rising? Are they on the decline? Is this a true value here? What's happening with the dividend? Does it pay one? Are you being paid for your patience? Did they pay one but cut it? Did it go away completely? These are all questions all investors should be asking. But also, if a stock is bothering you enough where you're on a chat board and you just can't take it anymore, we've all been there. We've all seen posts of, oh, I hate this stock. I've owned it for 5 years. It's going nowhere but down. The rest of the market is up. Why isn't my stock going up? In those cases, there's emotion there. Nobody likes to take a loss. None of us do. And we don't want to believe that maybe we got it wrong on this particular company. But sometimes it's just better to rip off the Band-Aid, sell for that loss, counter it with a gain in another stock, perhaps where you do have profit. And then trust me, you'll feel better immediately after you sell it and after you move that money into something else. So let's take a look at 5 stocks on this podcast that have been challenged in recent years. They're well-known names. I know many of you have owned them. Should you be doubling down on these stocks? Should you buy more here if you've been in it for a number of years? Or maybe even if you haven't been in it, should you get in it now? But these are all challenge stocks, but let's dive right in and check them out, because I think the charts and what the earnings are doing will tell you what you need to do. Okay, the first one I have talked about numerous times on the podcast in the past, and it's Walgreens Boots Alliance. If you're from Chicago, Walgreens is headquartered in Chicago. Many people work there in Chicago, so we're all familiar with it. We shop there. It's on our local corners of, our neighborhood. So it's hard to believe that this storied company that's been around a long time could be in this amount of trouble. But let's take a look at the price and consensus and surprise chart on Walgreens. So we have this new quote page on Zacks.com that we're testing out, and I just brought it up here. You can see it, and it brings up the price consensus and surprise chart right out of the gate. So this gives us a lot of information about Walgreens. Not only does it show us that it's, way down here at 5-year lows, basically. And these are like multi-decade lows, I believe now. But it also shows us that it started to miss here last year, miss, then it had a couple beats, miss again. It did beat last quarter by 8.3%. But take a look at the consensus for the earnings. This is not what you want to see. You want to see the consensus chart going up and to the right and growing. You want to grow your earnings as an owner of a company. You don't want to see down and to the right. So while you may say, oh, this is cheap, is it cheap with the earnings plunging like this? And look at 2026, this tan line really plunging down. I'm going to scroll down a little bit because this is going to give us a forward PE. Okay, so it's at 5.7. That is dirt cheap, but not really with the earnings expected to decline in that way. And you can see it in this sales and EPS growth rate. You want to see green. You don't want to see it going down here in the red for the next, couple of years, basically. So they did cut their dividend, and they still are paying one, as you can see, $1 a share. It is yielding 11.5%, even because the shares keep plunging. But who knows if that will even be safe? Unclear. You'd have to listen in on the conference calls. But when I see a stock like this, plunging like this, you're not really seeing any kind of turnaround, at least not in those earnings. And why should I stick around? Because I'm getting that $1 dividend when the rest of the market is hitting new all-time highs? No, like this, you should just be out of this. Even if you bought in 2022, you're taking this huge loss. I wouldn't stick around in something like this. I've been burned in retail many times myself as well. But when retail goes bad, it is very difficult to turn it around. Can be done, but very difficult. And there's a lot of changes in the industry Walgreens is in terms of the pharmacies and healthcare in general and what's going on there. So Walgreens Boots Alliance, WBA is the ticker. I hope it does turn itself around, but I wouldn't be sticking around in this one. So that's on the retail side, WBA. Okay, so since that one wasn't fun, let's talk about the one I am in right now myself, because as I said, we all do the buy and hold, and then something is going on. But my stock is APA, ticker APA. I did a whole podcast on my journey in APA, which began in the early 2000s. I can't even remember exactly when I bought it. I want to say 2000 or 2001. So that was when energy was in a bull market. The rest of the stock market was busting, and it was a good time to be in energy because the stock soared up through the highs of energy, with oil hitting new all-time highs in 2007. But it is a cyclical stock, and cyclical means it has these cycles, up, down, and you really shouldn't hold it the whole time. I talked about this on the other podcast, but you don't want to be a really long-term investor in a cyclical stock like a commodity, because there are long bear markets. But I stayed in it through the financial crisis, and then there was a massive bear market up through the pandemic, really. But I was already in it. We hit the lows back here in the pandemic, and then we did see the surge out of those pandemic lows. And this 2020 through here was when the Pfizer vaccine was announced, or right around here in November of 2020. And that's when many people thought, oh, the global economy is going to be able to reopen and things are going to take off. And oil demand, energy demand is going to rise. And that is what happened. And the stock did soar. So I was buying and dollar cost averaging all down here in 2020. I did not buy at the very lows down here. I think it was around $3 or something. But I did get in various other points as it rose there. But I still am below my basis from way back in 2000. And that is the danger of, oh, I'm going to add to my position and I'm going to dollar cost average down and it'll be okay. It takes a tremendous amount of buying if you bought, say at $100 and the stock is now at 20. You have to buy a lot of shares to bring down that basis. Trust me on this. I know, because I did get above my basis up here in 2022 when the stock finally retook $45 here. And then even here, also in 2022, when it also hit around there. But now that it's pulled back and is down, at 3-year lows here, now I'm back below my basis again. So these are the questions on the cyclicals. What do you do if you've owned for a while? Let's say you did buy it down in here. You bought on the lows, as say Warren Buffett has with Chevron. He was buying some Chevron in here 2020 and 2021. And Chevron has pulled back as well. But, you may think like, oh, I'm getting this cheaper. Look at the earnings. The earnings have come down as the price of natural gas and oil has come down, but they're kind of stabilizing to a little bit lower here. And with crude still above $60 and even above $70 for most of 2024, these companies, these producers are very profitable. So I'm not as worried on a cyclical stock that we won't see the earnings rise again at some point, probably in the next year or two. But I might have to wait the next year or two for my troubles. Now, APA for now is paying this dividend over here, yielding 4.4% now as the stock has declined. These dividends may not stick around and often haven't with the oil stocks if oil goes below, say, 50 or certainly below 40. Then they will cut dividends and then you'll get nothing. But for now, you are getting a decent dividend for your troubles. You could dollar cost average here, and I have been, but not crazily. But again, just like with Walgreens, if you can't sleep at night, if you are cursing APA or any of the energy stocks, which I've said, many of them look like this chart. If you're cursing these, then, it's not the investment for you. but these are cyclical. I do expect those earnings to turn around. This is cheap right now, even with the declining earnings, forward P of 5.7. And you can see on this sales and EPS growth, we had the green in 2021, 2022, huge green, because that was the Ukraine war and energy prices up. But now we can see the decline over the next couple of years expected here. So these really try your patience. It's really not a buy and hold type of play. I've just gotten stuck in it. But it's not, and I have sold many of my other energy stocks that I've owned during this boom period here, and I have gotten out of most of those. So any of these energies, they're hard, but cyclicals, hopefully the cycle will rise again. But if you don't have the patience, then you shouldn't be in any of these types of commodities and energy plays. So that's APA, ticker APA. Okay, let's switch over to another one I know many of you own. I've talked about it in the past, and it might be recovering now, Disney, ticker DIS. I see right now on Zacks.com, it's a number 2, so I'm liking that. And this is an interesting price and consensus chart because it did have the big sell-off, multi-year lows, even lower than the pandemic last year, which is hard to believe because they had their parks closed. People weren't going to the movie theater for their movies. And yet it was lower, the stock price, than in 2020. So we all know their troubles. We know the problems with streaming. We know, management changes have happened. It's trying to recover out of there. It's got a lot of beats in a row. I do like that. But look at these earnings. Decline, but we are starting to see with 2025 and 2026 a little more optimism from the analysts there. It is slightly higher than 2024, which is reverse course. It's no longer on the decline and it's up and to the right. So that is some recovery. But I know many of you have owned this stock for many years. Some of you bought it for your kids. You might have owned it for even 20 years. And so that's why you're in it and you're willing to ride it out because you say, this is Disney. It can't really get that bad, can it? But if you've owned it all that time, you know that it can be pretty difficult to kind of stay in it. On Zacks, we have this comparative chart that actually does give like a 20-year data back. And the chart's not that great, but I'm putting it up. And so I bring up Disney. I'm going to put in another symbol. I'll just put in the VOO for the S&P 500. That's the Vanguard. Let's see if it adds it. Why isn't it adding it? Or maybe it's just not liking that one. Okay. Oh, wait, here we go. Let's see if I can just add the index because we do have that option. Composite. Let's just add that. Let's see. It's not liking either one. It could be because it doesn't like the 20-year. It takes sometimes the data a bit time to load. Oh, you know what else? Because it's on price. So let's do percentage change on the scale. There we go. Okay. But you can see here the problems it's been having. I'm going to get rid of that index and try to get the VO back on there because I just like looking at that one better. Okay. It's giving me price again. It's a tricky little graph. You got to really readjust every time. Okay, change percentage. All right. So we got the VO on there now, and you can see over the 20-year period, Disney's in the blue, VO is in that kind of greenish line, citron, I would call that. But the VO is definitely outperforming Disney now over the 20-year stack. And I think a lot of the long time, oh wait, this only goes to 2010. All right, let's do 10 years then. because I want to get the full VOO in there. It's loading the 10-year now. But with the struggles of the last couple of years, well, you can even see it on the 10-year now. So it definitely is outperforming it on the 10-year. You have Disney up just almost 40% for the 10 years. VOO is up 247 or almost 48%. 248%. Disney only up about 40%. You did get a dividend with Disney for part of that, but you also got a dividend with the VOO, which is not reflected in this. So that is pretty dramatic. But when you're a long-term shareholder, sometimes you get used to back here, 2021, where you're running kind of neck and neck with the S&P 500. And then you get this big sell-off and you say, I'm going to be patient. I'm going to stay in it. And many of you did. It's starting to turn around. So the question is, should I buy shares of this loser stock? I know some of you did during this period because this is only a couple of years. If you're a long-term shareholder and you think Disney is a deal here, then, why not buy more if you do believe in it? But like I said, those earnings are seemingly turning around. It doesn't look as trappy as like Walgreens did. We have this fiscal year earnings growth of 8.2%, 13% for next year. So that's not so bad. It is trading at 21 times. So it's not really cheap here. But I can see why someone might dollar cost average into it here if you've been in it for, many years, which I know many of you have been. So this just kind of tells you how difficult it is to beat the S&P 500 and to pick the right stocks, because for many years, Disney was the right stock. And only in the last couple did it suddenly turn into one of the wrong ones. So this is why investing is not easy, and the indexes are the way to go for many people. But many of you bought this because you wanted to own it for your kids. So I would maybe be buying some shares. I would have maybe dollar costed average over the last couple of months into these now that I see that the turnaround might be happening. But this one's a little bit better story than Walgreens. So that's Disney, ticker DIS. Another one that's similar that I know many people have owned off and on over the years, Pfizer. We've talked about it, PFE. It did surge during the pandemic, and now it's back down again. So it had a little bit of a reprieve. But if you've been a long-term shareholder of Pfizer, it makes Disney look good over that 10-year time period and certainly over the 20-year. So just looking at the price consensus and surprise chart, it has a good surprise track record. The last miss was in 2022, so that's not an issue with it. But look at the earnings. It's coming down after, COVID has kind of declined. It's not making as much money off the vaccines. And so you got this earnings decline. Now it's trying to recover. It's basically flatlining and trying to see a little bit of growth here. But compared to many of its peers that are in the hot drug areas or have some kind of key drug in the works on like Alzheimer's or that kind of thing, they have the weight loss drugs, then this is not a good price and consensus chart. But I know many of you are owning it for possibly this dividend. It's yielding 6.5%, but you do have to wonder if that will stick around. There's no indication it's not going to. They've kept their dividend over the years to reward the shareholders who've been sticking around. But is this one you want to be adding, especially if you've owned it up here? It has, as I mentioned, been a difficult, basically 20 years. It's trading at 8.8 times. The PEG ratio is low. Let's look at the detailed estimates real quick and just kind of see what is happening with earnings. So this year up 58%, but next year is kind of flat. Same with sales, down 0.7% for next year. So I'm not sure where that growth is. This happens all the time with the drug stocks, but Pfizer just probably going to lag for a while. So with a lot of other names out there in the drug space with these big cap pharmas, you have to ask yourself, where else can I get a dividend? It might not be 6.5%, but it still could be above 2%. And where there is more growth on the earnings side and the sales side, and maybe they're in better drug situation and, have more things in their pipeline. So I would probably stay away from Pfizer. It's almost lured me in several times over the years, but you really have to look at what the pipeline is with these big drug stocks. And this one looks to be challenged for next year. So these shares could stay challenged for a while here. So I don't think I would be adding to Pfizer or even jumping in it at this level. But it is, a very particular game with the drug companies, because obviously if you get a hot drug like the weight loss drugs, then you're off to the races. So that's Pfizer, ticker PFE. And then I get asked questions about this next company all the time, and it's Intel. How many years have people been asking me about Intel? Since 2000, basically. It was one of the tech titans of the 1990s. Shares soared. If you worked at Intel, you were on Easy Street. There were Intel millionaires like Microsoft millionaires and Cisco millionaires, people who had worked there, for the prior decade from stock options. They got very wealthy. But we know some of its problems in recent years, and it's not been in key industries. And now there's questions about it with AI as well. Taking a look at the price consensus and surprise, it has had 2 big misses in a row. So I don't like that. But more importantly, we need to look at the earnings. And it's been struggling since 2022, down and to the right. And even for next year, some earnings growth there, but the analysts are still cutting for next year and 2026. They're getting a little more negative on the future with this company, and that's not what I like to see. So if I'm owning it all in this time period, thinking, oh, the new CEO's just arrived, he'll turn it around, but he's been there and we've had 2 big misses and now earnings still may be going the other way. There's a lot of semiconductor companies out there. You don't have to be in this one. I know many people are loyal. Many people think, oh, it's cheap. And how much lower can it go? We don't have a forward P on it for some reason. Oh, maybe because it has negative earnings for this year. Let's see. Let's look at the detailed earnings. I didn't even realize that it's actually negative. So I'm not liking that at all. For a company of this size, yes, they're supposed to lose 7 cents this year, down from $1.05 last year, and then rebound back up to 93 cents for next year if they can do that. But when we have all these other semiconductors, crushing it because of AI, and it doesn't even have to be NVIDIA. It could be AMD. It could be Broadcom. There's many others. Why own this one? Why dollar cost average as it plunges? You don't need to be in this one. Rip off the Band-Aid, get out of this, get into one of the others where you're not going to be cursing it on the chat boards and saying like, why can't they turn it around? It won't be your problem anymore. Leave it to someone else. So this one I would not be adding here. And it's, I've been in and out of it many times in several of my portfolios here at Zacks over the years. Some of the insiders have been buying there many times over the years. I thought, okay, I'm going to follow them in. They're buying. But recent insider buys, I've not been following them in because I've seen this before in the last several years, and they haven't really been able to turn it around like they've all been talking about. So I'm going to go with the winners on the semiconductors. We know who they are. Join the winners, not this one here. So that's Intel, ticker INTC. So this is kind of a depressing podcast, right? Like, I didn't like many of these. Disney maybe has the best outlook with the earnings going forward here, at least into 2025. And it looks like it's probably gonna, turn it around. Its streaming business is a little bit better, and the parks are still holding up, even though some of those inflationary pressures are hitting. Those ticket prices are high, and some consumers might be pulling back a little bit on that, but not so much since it is Disney. They do have the brand to hold that consumer. But other than Disney, a lot of these others, I would not be adding. If I was in these stocks, I would try to rip the Band-Aid off. APA, I do own it myself. That one is cyclical. I'm watching it. I've, been adding because those earnings have come down, but have stabilized here. And with cyclical stocks like that one is, the earnings should be rebounding when the price of oil rebounds. But the question with energy is, it may not for a year or 2 years, and then you're sitting in these stocks. So lighten your load. If you're in a lot of the energy stocks, you don't need to be in more than one or two of them, and keep it a small percentage of your overall portfolio. For some of these retailers that are struggling, there are retailers that are not struggling. Go buy them. Don't stick around in some of these ones that, year after year, quarter after quarter, they're like, oh, maybe this will be the thing that turns us around. It's very difficult industry. Many of the retailers, like the ones I listed at the top of the podcast, will not survive. And so it is hard to be long-term investors in the retail stocks, because a stock that's trendy for a number of years then is not. Same with restaurants. Cava, Chipotle, Cava's super red hot right now. Chipotle has been red hot. Then it sold off and plunged. Then it got red hot again. And now we'll see. McDonald's has had its ups and downs many times over the last couple of decades. Starbucks, same thing. Starbucks going through its own issues at the moment as well. And I have talked about that one. I've owned that one for a decade as well. But these five, the shares are down towards 5-year lows. Disney's come off of its low, but many of them challenged. APA not yet at the 5-year lows. It's got a way to go for that one. But when you get down there, start to ask yourself, go look at the earnings, see what the outlook looks like. Is this a company you want to own? Zacks has over 4,000 companies with the Zacks rank. There's over 200 of them with the Zacks #1 ranks. And that means rising earnings estimates. You do want to see that. And there's a lot of choice out there. So it's emotional when you get a stock like this. It stinks to take losses. But trust me, once you rip the Band-Aid off and you get out of it, then you will feel better. Even if you take a loss, you will feel better. And, get into either an index or something else that you will enjoy being in and hopefully performs better. But investing is hard. And this is one of the hard lessons that everyone, even Warren Buffett, has to learn. So let me recap the stock tickers again. If you're a bottom feeder, you could go check them out. You might not want to, but maybe you do. Maybe you just want to go check it out yourself. So there's Walgreens Boots Alliance now, ticker WBA. W as in Wayne, B as in boy, A as in Adam. Then we had APA, the energy stock, ticker A as in Adam, P as in Paul, A as in Adam, APA. Disney is ticker DIS, D as in David, I, S as in Sam. Then we had Pfizer, ticker P as in Paul, F as in Frank, E as in Edward. And then we had Intel, ticker I, N as in Nancy, T as in Tom, C as in cat, INTC. And as always, I aim to bring you stocks and whatever else, ETFs and things that are going on in the markets every week. We've talked about gold. That might be back on the menu again in the coming weeks. And I will have Mark Zinsky, who's Zacks microcap analyst, back on in the new year, because I know many of you enjoyed that small cap podcast we did recently, and you should go check it out on the small cap AI stocks, because there are a couple of them, not a lot, but there are a couple of them that are out there. And he's got his eye on a couple other small caps that are in the medical device area. So that's what we might cover in 2025. Be sure to subscribe. Get us here on YouTube on Zacks.com/YouTube, or put in Zacks Investment Research into the YouTube search bar. You'll get us there. Get us on Apple, get us on Amazon, get us on Spotify, and anywhere else you can get podcasts. You can get the audio podcasts. But be sure to get us somewhere, and I'll see you again next week with some more stocks.